Okay, and now, of course, the NFP, the non-farm payrolls. I would easily say it's all about the money. There's a 90s song, or early 2000 song, goes something like that, all about the money. Wages are important, more important than payrolls by far this time. You can say it with confidence. So this NFP is critical. Why? Because there's high uncertainty about the June decision. The Fed makes its decision in exactly 2 more weeks. The Fed is data dependent. It has 2 mandates, jobs and inflation. Wage growth sanitizes both. That means that if we have strong, if the U.S. economy is at full employment, that means that that job gains should slow down because employers find less people to hire. But because there's a higher competition for employees, they raise their wages. When wages rise, people consume more, and they don't consume only more food or more energy, the more volatile items that the Fed does not care about, but they consume more big ticket items. And this pushes core inflation higher. So more furniture for the house, more cars, televisions, you name it. And this should push prices higher, and then the Fed should raise rates. So that's the key. That's why wages are now important, because we're at a point in the cycle where the Fed wants to tighten as we're nearing full employment, and the best reflection of full employment is rising prices. So high job gains plus no wage gains, still a lot of room to go. That's what we had last time. So we're not at full employment because we had so many jobs gained and wages got stuck. The economy is far from overheating. So steady, slow, frustrating growth, you name it, but not overheating, that's for sure. Last time on the non-farm payroll show, the king of Forex indicators, 211,000 jobs were gained. The unemployment rate dropped to 4.4%, which was a point of envy maybe for many countries, but the participation rate is lower. So if you're counting less people as the workforce, and out of this smaller group, the unemployment rate is falling, less people are out of work, it's not such a good, not convincing enough, let's put it this way. Wages did disappoint last time with 2.5%. Year over year, a setback. It's not too bad, but it's the average. It's not overheating. It's not getting closer to 3%. Each time we take a step forward, we take a step backward. This time, we're expecting more or less in terms of jobs gained, 186,000. Wages are expected to rise 0.2 month over month after 0.3 last time. That's the month over month, not the year over year. Jobs expectations are going to be shaped, of course, by the ADP, but not wages. ADP does not give us wage information. Remember, as always with the non-farm payrolls, the initial reaction to the news is not necessarily the correct one, especially if, as we've seen last time, the first reaction was to the headline, jobs gained, and not to the wages. So how do we trade it? First of all, with low leverage, because it's a very volatile event, and take care out there. My prediction is, if wages are 2.5% year over year or lower, that could be an ominous sign for the Fed regarding the June decision, and the US dollar could fall. If they're at 2.8%, the cycle high, or even higher, then I think it provides a smoking gun for the Fed to shoot to raise rates in June, would alleviate concern, and the US dollar could move to the upside. In between, which doesn't leave too much space, 2.6, 2.7, I think it leaves a lot of room for speculation, for choppiness. In any case, as aforementioned, ignore the initial move that could be only related to the headline jobs and focus on wages. Okay. Any questions before we move to our next segment? Is the pound.